Hi, today is Saturday, December 8th, 2018. I'm taking a look at the S&P 500 as we look to start trading for December week 2 and as we sit and wonder if we're going to get our quote-unquote Santa Claus rally. This is the gap map. This is the simplified version of the roadmap chart. I initially put this chart together to keep track of all of the gaps that we have that we've made and that we've filled, and also to focus more so on the simple moving averages, and also to highlight this measured move target that I first presented back in October. When we go in a little bit closer on this, I want to talk real quickly about this measured move target to save people the time of rewatching those two 10-minute videos that were posted for October 26th and November 4th. This measured move target uses this first low that was made here in the sell-off on October 11th. This is a key level because we came down, we bounced off of this level, and we made what still remains today our bounce high of the sell-off, the October 17th high. So this low it is a significant level because of that, because it sort of marked the first line in the sand, sort of like the trampoline, the area of the trampoline, and we bounced up here to what still remains our bounce high, a fail of the 100-day simple moving average. At the time, it was a fail of the 10-day simple moving average as well, and then was followed a couple of days later by a fail once again of the 200-day, and then that liquidated us down. And once we broke this level here, if you look at this space of this bounce down to this low down here, you had a doubling down of that move in and of itself right there. So if we were to take a box simply and measure it back to this level and move it down, you can see that this low that we reached was practically a perfect doubling down of this move, of this the height of this bounce. And once the floor was broken, we doubled down again. Okay, so in that same vein, if we were to look at this big overall move here, okay, and see it doubling down, that would take us down to 24.80. Now, yes, we have broken down into this a few times and have not successfully ventured more than about halfway through this range. But eventually, I do believe that we will, and we will go down and make this double down move. And then I took this 24.80 level and I compared it to where we were when we first traded 24.80 on the S&P 500, and I saw this ginormous gap here at 24.61. This is a huge gap. See how thick this bar is? That's how wide that gap is. And when you compare it to how wide this little bar is here, this is our little gap here. This is this teeny weeny little gap here, and this is a little gap here. Look at this gigantic gap here. This gap starts out at 24.75 and fills at 24.61. So that is a big gap still left in the wake of the move up that we took, that took us all the way eventually to our all-time high at 29.40. So when I back out this chart, these are, so you can see here is that actual, here it is right here. Here is that actual gap right here. It's between the September 8th and September 11th candles in September of 2018. See all these gray lines, all these price levels? These are all unfilled gaps. All unfilled gaps that have been made in the wake of the election. So the lowest print that we've made since the election is 21.25. There is an unfilled gap going into the election at 20.85. And then there are all these unfilled gaps all the way down there. Okay? So one of the reasons that makes this gap so important here, and that if it fills, that it be one of those events where we go into it and we don't quite fill it and we reverse and come back up, is because if this gap breaks, it is opening a can of worms that is so deep it could take us all the way back down, all the way to 21.25, if not 20.85, and fill all of these gaps. So that's the importance of that gap being addressed, and being addressed with buying interest. with a heavy buy program that moves in and protects this gap. Because if we were to enter into this gap on a heavy sell program and it breaks, um, the 2400 handle will be a distant memory within a couple of hours, probably. And we'll be trading down very quickly. It'll be like one of those kind of like weeks that we saw in 2008, where the S&P would just go down 100 points a day, day after day after day. And that's what it would take. And I think that it would be a very, very fast 300-point move in no time at all. Because obviously this is a huge buy program that left this gap in the first place. This is a huge amount of people that got long and took us all the way here to 29.41. And if they are interested in keeping this market afloat and keeping these gains of the Trump presidency afloat, then they're going to step in here and buy. What would be an event that maybe breaks this level and takes us down even lower? I don't know. Maybe more and more information coming out about the Mueller investigation. Maybe our president getting impeached. Something like that. So that could be the kind of thing. And that rhymes really well, doesn't it, with going all the way back to the beginning of this presidency and taking back all of the gains that were ever made. That would make a lot of sense, wouldn't it, if it had to do with an event like that? So keep that in mind. Know that we could have a move all the way down here to 24.61, but eventually that 24.61 is going to break, and we probably are eventually going to fill in all of that stuff that's left open down below. Okay. So anyway, that is a quick re-explanation of this measured move target and why I point to this 24.80 all the time, followed by this 24.60 level. Okay, so now let's talk about what's going on right now. Right now we are churning basically the starting point of what makes this measured move for us. 27.10.51 is that level. Our halfway back right now for the month of December is 27.10.80. And our 10 and our 20-day simple moving averages are sort of tweezered around this level. And our high on Friday failed at 27.08. So it failed just shy of the 27.10 level. So the low that we set on Thursday came down and back tested quite a lot more closely than we ever did in November. Back tested much closer to the low that we made in October at 26.03. So if we want to stop looking at this stuff down here and just address the fact that 2600 handle seems to be holding, we could even build on an uptrend here, and that maybe we are going to start to see some buyers come in next week and get this rally on its course. If that is the case, this is what we need to have happen. Okay, first we need to get through the midpoint of this range that we put in on Thursday and on Friday. And you can see Thursday's open here at 26.63. That marks a great level. The halfway back point of the range that day was 26.58. I kept tweeting about that level quite a bit. So this whole 26.58 to maybe 26.65 level, that needs to come out, and we need to move above that, and then we need to go after Friday's high, take out the 10 and the 20-day simple moving average, and move above 27.10.51. If we can move above this and maybe close above this on Monday, then we can go after and address this death cross. We have not seen a death cross like this since the sell-off that went on in late 2015 and then rebooted again at the start, the first trading day, January of 2016, and led us down to that 1810 low in February of 2016. That's the last time we saw a death cross like this. Every single time the 50 and the 200-day, the pink and the blue lines have come anywhere near each other, we've seen buy programs start up and fend it off. And you can go back through a daily chart of that, and then you can roll back on a daily chart on your own and see that sort of double dip sell-off that I was talking about a week ago. About a week or two ago, I started talking about how this death cross was coming at us, and that it's either going to be treated for what it is, which is the average price of about a quarter, which is your 50-day, versus the average price closing price of the 200-day, which is about 1 year, that here we are in the fourth quarter, and the average closing price of an S&P 500 component, the average closing price just now dropped against the average closing price of the whole year. Is that an oversold event? Is that an event that makes you want to buy because now you're getting your bargain bottom price? That is the best you're going to do right now. Let's get in there and buy it. Or is this the red flag saying that don't touch anything? This is nobody is getting long. This is not confidence in the market. This is prices of just this last quarter dropping below the whole average price of the year. This is a huge red flag. That's why they call it a death cross. Okay. Anyway, we've got to get through 2710, and then we've got to retake the falling 50-day simple moving average, and then we need to take out the 200-day and close back above it, and we need to make it stick. This little set of two closes here, this wasn't even two closes. This was a single close above the 200-day, and then a fail to follow through and make a second close above it. We need to put in two closes above the 200-day, and then maybe we're finally going to have the power we need to take out and address this monster. This yellow line is the 100-day simple moving average. This broke back here on that first liquidation move down. And the first bounce failed it, the second bounce failed it, and obviously the third bounce failed it as well. This is a falling level. I think that paying attention to the 100-day simple moving average is more important even than paying attention to this high we made in October. Okay, if we can take out the 100-day simple moving average intraday, and you can see here, it has not been traded above, not even intraday since this liquidation move on the 10th of October. And we've got the 10th of December coming up, so it's a perfect 2 months later. Can we maybe make a move out above this 100-day on an intraday basis and put in a close? And we've got to put in not just one close, but two closes in a row. And I think that's going to be your big trend-changing event. This is a falling line. It's at 28.11 now. It could be all the way down here in a couple of days to to maybe even passing below 2800. And that's all it would take. Would be a close then above 2800, put in two in a row, and then we go after 2846 or 2850, if you want to call it that, scene of crime level. And if we can take out that, then we go after these two gaps at 2880. And 29.25. Okay, so that's your upside. If we come in on Monday and we have continued weakness, then we're going to simply break this 2621 level, and we're going to either make a closer back test and hold the 2600 handle, or we're going to finally poke our heads underneath 2600 and visit a 2500 handle. If I were to back out this chart and show you this big falling wedge that we have on the S&P 500, with the bottom of that wedge starting at the all-time high made in January, crossing down through this 2603 level and letting that line just sort of extend out, we come down to the 2560s, and that's what would hold the bottom of that falling wedge. In terms of what that means against what has happened earlier in the year, a hold at the 2560 handle would rhyme with holding against 2553, which is the April low. That was the back test of this low, the low for all of 2018, which is 2532. Okay, so if we go lower and we cannot hold 2600, let's keep our eyes peeled for a possibility that we come all the way down here to the 2560 handle. There is the May low in the way at 2594. There is always the idea that we just make a little simple, smaller low, and smaller lower low than 2603, and we find buyers that snap it right back up, and it's a complete non-event. It'll be like just blinking. It'll be like something that happens in a single 5-minute candle. Okay, if it happens like that, fine. But if we have a day like what we saw on Tuesday and again on Friday, where we just melt down and we melt right through 2603, keep in mind the April low at 2553 and this little falling wedge line that could be guarding it to make a higher low against. And then if this stuff all goes, then just remember, we have our big ultimate target down here. There's some stuff in the way that could hold. They like to drag this out and make this as long and as painful a process as they possibly can. We could come down here to 2560, bounce to 2800, and then come back down again, a little lower, bounce, and come back down again. I mean, look at this chop, look at this 2603 all the way to, 200 points up to 28, 2813 or whatever this was, 210 points. We could chop around for quite a long time. But in any case, that would be what's going to happen at the downside. We're going to fail the 10-day simple moving average, come down, and if we can't hold Friday's low, let alone Thursday's low at 26.21, and we look to 26.03. Everybody and their mother is looking at 26.03. Everybody and their mother is also looking at the 2018 low at 25.32. I think that this right here offers a great spot to just sort of screw everybody over. Everybody's going to be like waiting for that 25.32, and they're not going to cover their shorts. They're going to not believe in this bounce that happens here. And you can just see a day happening like this one where we hit this 25.60 and bounce like 30 or 40 points to close like almost at 2600, and everybody will be all loaded up short, and then they'll come in the next day and they'll just rip it higher. You just know it'll play out that way because that's the way they love to do it. Okay, anyway, enjoy the rest of your weekend. I hope that this video kind of caught you up again on why we have this measured move, caught you up again on why we have these gaps that we talk about, caught you up on this death cross, and also caught you up once again on the fact that this 100-day simple moving average is probably the most important thing overhead that we have to take out above anything else, because the chart has shown us that this is where supply comes in. Okay, that's it. Have a great weekend. See you Sunday. Good luck and good trading.